Hey guys, this is a deep dive into Howard Hughes. My goal of these deep dives is to take about 30 hours of research and condense it into a 30-minute video to give you most of the information you need to make an investment decision. Please drop a like, follow, subscribe if you enjoy this. Let's dive in. So there's one key question to ask yourself. Do you want Bill Ackman, one of today's best investors who is rolling out Warren Buffett's playbook, to work for you essentially for free? So as always, the 5 things I look for when picking stocks. Is it an exponential growth opportunity? How are the fundamentals? Is there smart money involved? And how does it fit within my framework of risk appetite and time horizon? So the first character in this story is Warren Buffett. He's the founder and CEO of Berkshire Hathaway and considered one of the greatest investors of all time. His net worth is about 150 billion, and it would have been double that probably if he wouldn't have given away so much to charity. He managed to get a return of about 20% over a period of 60 years. Today he's 95 years old and about to step down as a CEO of Berkshire Hathaway. But here you see the immense growth he has realized in the market cap of this company, starting at 22 million in 1965 and ending up at 1.1 trillion today. So this is the performance versus the S&P 500. It's a logarithmic scale, so keep that in mind. So a really big overperformance. And Berkshire Hathaway is what we call a diversified holding company. We'll talk a bit more about that later, but one thing to know is that they have one part of their business where they completely own companies, working in different types of verticals. Insurance is a really big one, as we'll talk about, but also railroads, service, retail, and manufacturing. And on the other side, they partially own companies through the holding shares that are listed on the stock exchange. And a few famous companies that they've held are Apple, Coca-Cola, BYD also rather recently. And they hold on to these companies for a very long time. So the second character in this story is Bill Ackman, the founder and CEO of Pershing Square Capital Management. He's considered a bit of a rock star activist investor. He wouldn't agree with the activist part anymore. That was more in the beginning of his career, but he still has a lot of influence on the companies he invests in, but now mainly through his reputation. He has an estimated net worth of around 9 billion according to Forbes, and over a 22-year period he managed to get a return of 21.5% excluding fees. Now this is higher even than Warren Buffett had, but what he would explain you is that Warren Buffett's fund has gotten so big that it's become more and more difficult to get higher returns. Today he's about 59 years old and he's squarely in the public eye, very active on X. Constantly in the news, several books written about him and his biggest trades. And one of the funniest covers I think is on Forbes in 2015, where he was even called Baby Buffett, so after Warren Buffett that we just discussed. And Warren Buffett has had a really significant impact on him and the way he invests. And the best way to see that is to show it a bit in his own words.
You mentioned Warren Buffett. You said you admire him as an investor. What do you find most interesting and powerful about his approach? What aspects of his approach to investing do you also practice?
Sure. So most of what I've learned in the investment business, I learned from Warren Buffett. He's been my great professor of this business. My first book I read in the business was The Ben Graham Intelligent Investor, but fairly quickly you get to learn about Warren Buffett. And I started by reading the Berkshire Hathaway annual reports. And then I eventually got the Buffett partnership letters that you can see, which are an amazing read to go back to the mid-1950s and read what he wrote to his limited partners when he first started out and just follow that trajectory over a long period of time. So what's remarkable about him is one, duration, right? He's still at it at 93. Two, takes a very long-term view. But a big thing that you learn from him, investing requires this incredible dispassionate, unemotional quality. You have to be extremely economically rational.
So you can clearly see the impact that Buffett has had on Ackman. So looking at Pershing Square a bit, 2 things I want to mention here, the type of companies they invest in and the fee structure. So in terms of fees, Pershing Square charges their customers or their clients fees on the capital that they manage. So there's a management fee, a percentage on the money, the total amount of money they manage per year, and there's a performance fee on the return they generate. And you see that there's quite a difference between including the fees, the returns, and excluding the fees. Because those compound over time as well. And so these fees are something that Berkshire Hathaway doesn't have in their model. So that's an interesting thing about that setup. Of course, they're still well above the S&P 500, including the fees, but I mean, if you can have it without fees, that's of course much nicer. And then secondly, the type of businesses that they focus on, really high quality businesses. So these are not companies that are pre-revenue or pre-profit. So they look for companies with a durable competitive advantage, or a big moat, as Warren Buffett calls it. Exceptional management, so an owner and a CEO that thinks like an owner of the company. Scalable growth, so there's room left to grow for the stock, but also a mispricing. So usually they try to buy at a moment where maybe the stock price has had a big hit. So think of the Chipotle investment that they had, for example. They had some type of food safety crisis, which meant that their stock price took a big dive, but they were confident, Pershing Square, that was something that the company would recover from, and so it was a really interesting buying opportunity. So those are the type of companies they invest in. So let's have a look at one of their biggest investment vehicles, where they have about 90% of their assets, worth about 11 billion here. Pershing Square Holdings Limited, listed on the London Stock Exchange. You can see that they've had a pretty nice return so far. And so, like I said, the companies that they hold are really well-known, solid companies. You probably know most of these names. Here in the middle, you will see Howard Hughes Holding Inc. That's our first clue. So they mostly hold long positions, so companies that they think their stock price will appreciate. They've had some really big short positions as well in the past. So those are basically stocks where they think the stock price will go down, that they're overvalued. And Bill Ackman is not doing this on his own. He has a team of about 40 people around him. I will not go through each and every one of them, but I just took a selection. I think Ryan Israel is an important one. He's basically the third main character, I would say, of this story. He's the CIO, the Chief Investment Officer of Pershing Square. And so two things that stand out to me. First of all, they stay with the company for a long time, which is impressive. So Bill manages to attract really high caliber people, and then he manages to keep them on board in a very competitive industry. And secondly, all of these guys have a really impressive resume. So most of them start at Goldman Sachs and then subsequently work for some type of asset manager or a big private equity house before they start working for Pershing Square. So really impressive team of people behind Bill. So let's finally have a look at Howard Hughes. Howard Hughes Communities, as I will refer to them. They're in the business of buying big plots of land in locations where people would want to live. So think about Texas, Hawaii, Maryland, and they want to live there for reasons like the tax climate, economic activity, connectivity to other parts of the country, and overall quality of life. And so what they do on these plots of land is to build master planned communities. And so this starts by selling plots of land to home developers and using that cash to build utilities and amenities and commercial centers around these homes. This in turn attracts more people, which increases the price per acre. So they sell more acreage to home builders at a higher price than before, and again use that money to build more facilities around it. And this becomes sort of a flywheel, which generates cash for this business. And so a bit on this land appreciation, to give an example, in 2017 they had about 4 billion on their balance sheet in terms of value of land. They sold 4,000 acres since then for 2.7 billion. And actually, without buying more land, this amount went up whilst they sold 4,000 acres. And that is because the price per acre appreciated, because these places become more and more desirable to live for people as they become bigger and more vibrant. And so a bit of a look at their business model in numbers. So the recurring income is in 2025 is about 700 million, and it consists of 3 buckets. So that's the rent income from some of the properties that they own. It is the cash they get from selling land to home developers. And then they have profit that they have on buildings that they construct. So mostly condos and big apartment buildings. And against that, there's the cost that they have for running their business, paying their personnel, and the interest expense on the debt that they have to fund this business. And the difference between the income and costs is about 400 million, and they expect this to significantly increase. So increase because they have a lot of buildings coming online from which they will get rent. So they expect this to go up from 270 to about 360 per year. They expect land sales to be more or less flat. They hope it will go up with appreciating price per acre. And then finally, they have a lot of buildings, condo buildings that are coming online in the coming years, which should generate also about 175 to 200 million per year. They expect their costs to be mostly flat, which means that their operating cash flow will increase from about 400 million to 700 million. So that's cash that this business is generating, and they're not really planning to use that cash right away to buy another big plot of land. So they have different ideas for that. And so, like I said, the flywheel is basically that they build more commercial amenities, which increases the value of the land, which attracts more people, which makes it interesting to build more commercial activity. So that's sort of the flywheel. They don't have basically any competition because they buy such a big plot of land. Everything is sort of owned by them, so people cannot come in from the side. They have quite a good grip on that, and like a self-funding model where, like I said, they have rents that cover their interest expense and the cost of running the business, and then they have the land sales and the profit from building those condos that can be used for future growth. So let's connect the dots between Pershing Square and Howard Hughes. Howard Hughes used to be part of General Growth Properties. Pershing Square took a stake in that company of 25.6%. General Growth Properties then went into bankruptcy. They were funded a bit more. And when they came out of this bankruptcy, the Howard Hughes Corporation was spun out. And Bill Ackman became the chairman of that company. Since that time, they have funded it several times over. So they were part of the initial capitalization of 250 million. They invested 500 million during COVID. They did another backstop of 73 million in 2024. And then in May of 2025 of this year, they invested 900 million into the Howard Hughes holding company. So let's dive deeper into this 900 million transaction, because it's where the whole story comes together. So Pershing Square bought 9 million new shares from Howard Hughes. Pershing Square then becomes the 47% owner of Howard Hughes holding company. And with that, they transform Howard Hughes into a diversified holding company, just like Berkshire Hathaway. Bill Ackman will join the board as executive chairman, and Ryan Israel, the one person I pointed out in the team, who is currently the chief investment officer of Pershing Square, will also become the chief investment officer for Howard Hughes holding company. And so Pershing Square will support Howard Hughes in this strategic expansion as a diversified holding company to deliver advice, the capital markets, hedging, all these things. And Howard Hughes will pay Pershing Square a quarterly fee totaling 15 million per year and an incentive fee of 0.4% of the equity market capitalization. So this last fee is very different than the management fee that they currently charge their customers of 1.5% per year management fee and a performance fee of up to 20%. So zooming out, you have the Howard Hughes holding company, which is the stock we're talking about today. It's listed on the New York Stock Exchange under ticker HHH. So this is owned 47% by Pershing Square and the rest by public shareholders like you and I. And so this becomes an umbrella then for other companies. So first of all, there's the real estate business, the Howard Hughes community, the land business that we discussed. And then they want to add other businesses that they own for about 80%. And they want to buy them using the 900 million that they put in Howard Hughes holding, plus cash flow being generated by the land business and maybe some additional debt. And the first type of company they're going to start with is an insurance company modeled much after the Berkshire Hathaway model, because insurance plays a really important role in funding that business. And so the best way probably to understand why is to listen to Bill Ackman explain it at their shareholder conference.
So let's talk about insurance. So our focus on insurance, again, we talked about building a modern day Berkshire Hathaway. A useful exercise is to go back and read the history of Berkshire beginning in the 1960s. And a very efficient way to do that is there's a book called The Financial History of Berkshire Hathaway. I think the author is Adam West. and he did a really remarkable job. It's a bit of a tome. I don't know that people read anymore, but if you're geeky enough to show up at this meeting, you might want to buy this book. And it kind of walks through every transaction that Berkshire did over 60 years. And what's sort of notable as you read the book is you realize how important insurance has been to the progress and the profitability of Berkshire Hathaway. Difficult to calculate the quantifiable impact, but it's definitely more than half the value created here. Probably my guess is something like 70-75% of the value created has been through the insurance operation, but not so much from the profitability of the insurance company, but from the flexibility that the way the insurance company was managed in enabling Buffett to invest in common stocks. And when you read an article in the press that says Warren Buffett bought a $50 billion stake in Apple, it was really Berkshire's insurance subsidiary bought a $50 billion stake in Apple. And because Buffett's been a good investor in the stock market, and because he's created sort of low-cost liabilities in an insurance company, the combination's led to an insurance operation that's compounded its equity at north of 20% over a very long period of time. And the power of compounding is such that that's driven a large amount of the value of the business.
So they're buying an insurance company. In their annual meeting, they went into this in quite some details. I don't want to go as deep, but I think it's quite interesting to give a bit of a high-level overview. So basically, insurance companies have, when you look at their return on equity, they have two components. They have their underwriting return on equity. So this is really the core insurance part, and then they have investment return on equity. And so a typical insurer plays here, and this is the part where Pershing Square can really add value. And so looking at the four components, it starts with underwriting profitability or their combined ratio. So this basically means how good is the insurance company at writing out policies for a certain price and a certain risk, given the cost they have for managing that business. And so when we look at a comparison between different insurance companies, so you have the typical property and casual insurer, they operate at a combined ratio of about 95%, meaning they have a margin of 5%. So that, again, that's really the business of so how good are they at writing premiums to customers for a certain price and a certain risk, and running their business. So the typical insurance company has a margin of around 5%. Berkshire Hathaway has about 7%, so that's even better. And they think in their illustrative Howard Hughes investment company example that they can get to about 6%, so they're being a bit conservative here. So that's the first component. The first component is the underwriting profitability. The second component is the premium leverage. So that basically looks at, let's say you and I start an insurance company and we put $100 into this company of equity. And then the question is, how many policies are we going to write in a certain year? Let's say we write $50 of policies. So that means that our premium leverage is 50%. So we have $100 of equity, we write out $50 of premiums, so we have a 50%. If we would write out $25, it would be 25%. If we would write out 100, it would be 100%. So looking at, again, the comparison, so the typical insurer is about at 100% earned premiums to equity. So in our example, for their $100 of equity, they give out $100 of premiums per year. So Berkshire Hathaway is at about 33%, which is much more conservative, and that's probably also why they have a higher underwriting margin. Maybe they run their business better, but also because they don't expect their company to write a maximum of premiums every year. And when you're not pressured to do 100% premiums every year, you can be more selective and take the higher yielding premiums in the end, and you can get to a better underwriting margin. So Howard Hughes is expected to have premiums to equity of 50%. So that means from, again, the example, €100 that we put in equity, we write out premiums for €50. And so if you put all of that together, so you look at the combined ratio of 95 in this example, leading to a 5% margin. Of course, they need to pay tax on that, 21%, so you get to about 4% margin. Depending on what you look at. So 4% typical insurer, it's higher for Berkshire Hathaway, and it would also be higher for Howard Hughes. But then you need to look at how many premiums you gave out. So it's nice if you have a really high underwriting margin, but if you don't give out that many premiums, you don't earn that much money. And so since the typical insurer gives out 100% premiums for the amount of equity that they earn, this is 1-to-1, so the 4% margin is a 4% return on their equity. But since Berkshire Hathaway, for example, they only do a third, so actually this 5.5% turns into 1.8% of return on equity. And the same for Howard Hughes, they're at 50%, so the 4.7 is a 2.4% return on equity. So that's the first part of the business, so the underwriting part. And then we get to the second part, so the investment return. So the first is pretty straightforward. It's the investment performance. So what type of return does a company get on investing their assets? So what is important there is not only the return you get, but also the type of vehicle that you invest in. So a typical insurance company puts almost all of their investments into fixed income, so in bonds. And they get a return of about 4% on that. The 5% that they have in common stocks, they get about 10% return. Averaging on these at about 4.2% return. If you look at Berkshire Hathaway, so they have much more in stocks, 70%, and they have a higher return than the general insurance company at 12.5%, and that mix leads to a higher return on assets of about 9.7%. So then you have Pershing Square or Howard Hughes insurance company. They put about 60% in stocks, but they think they will have a much higher return than Buffett, about 20%. Given their run rate of 21.5%, that seems impossible, which leads to a return, a weighted return of around 13.2, whilst Berkshire Hathaway is at 10, and the typical insurance company is at 4. Now you might wonder why they would earn such a higher return than Berkshire Hathaway. That mainly has to do with the scale of Berkshire Hathaway. Like I said, they're about $1 trillion in market cap. It's much more difficult to get a high return on hundreds of billions of dollars than it is at the scale that Howard Hughes is operating on. So that scale advantage will lead to a higher return, they estimate. And so those are the investment results. And of course, after that you pay tax and you get to these returns over here. So we've talked about this and we've talked about this part. Now let's move on to the balance sheet leverage. So the balance sheet leverage is really about what percentage of your equity, so again the $100 that we put into our investment company, do you invest in the market? If you invest that full $100, you have an investment balance sheet leverage of 100%. If you do less, it's less. If you do more, it's more. And so looking at insurance companies, today they typically have 2.5% leverage, which is quite high. They also have relatively conservative investments, so maybe the risk is a bit lower. Berkshire Hathaway is about 1.7 and Howard Hughes is expecting to be at the same amount. And so if you're wondering how can it be more than 100, you have the equity that's in the insurance company, so the $100 in our example, but then also of course you write out premiums, which are, you hold them in cash until you need to pay it out eventually, if you need to pay it out, so that money you can invest between the moment you receive it and the moment you need to pay it out. And then subsequently you can take on some debt to get more leverage. And so what you need to do is to multiply the return that you get on your investments by the amount of leverage you have. And in that case, the typical insurer comes out at around 8.3% return, Berkshire at 13, and Howard Hughes at about 17%. And so when you add the return of the underwriting business, you see these total returns on equity. So 12% for the typical insurance company, 14 or 15% for Berkshire Hathaway, and 20% for Howard Hughes, which is a really interesting compounding return. And so again, that basically comes from the fact that they would write more premiums than Berkshire Hathaway, and they would have a higher return on their common stock than Berkshire Hathaway. And of course, the mechanics are quite different versus the typical insurance company. So that's why they think they would be very well situated in running an insurance company, and that company will then generate the cash that they can use to buy new companies. So this is really where the value of Pershing Square is going to be. So what is the status today? So they're actively evaluating several interesting targets, and they are engaging with investment banks to identify those opportunities. They're talking to industry-leading executives that they would want to bring onto the board of this company. And today they have already executed a non-disclosure agreement with one party, and they did their preliminary due diligence on it. They have made an offer which they say is well in the ballpark of what the company would want, and they would soon get a 90-day due diligence period. So it would be theoretically possible that they, by the end of the year or the end of January, would announce this acquisition, and they estimate that it would be a couple $2 billion in value. So this is progressing quite well, and we'll probably see something soon. So coming back to this overview, by the end of January we could have a nice insurance company sitting here, which means that then you would have two businesses, the land company and the insurance business, generating cash into Howard Hughes Holding that then can be used to buy a subsequent company. So what are the risks here? There's definitely a bit of key man risk. Bill Ackman is the star of the show, and a lot of this is riding on his reputation. I do feel that with his CIO, Ryan Israel, he is looking for a successor. Of course, Ackman is 60. Warren Buffett went on until he was 95, but who knows how long he will go. So there is key man risk, but I have the feeling they're preparing for succession planning at some point. Past performance is no guarantee for future results, so this really hinges on Pershing Square's ability to use the funds that Howard Hughes generates to buy new companies that would then show an appreciation in stock price. If they don't manage to find these target companies, there will be no return. Of course, they have a strong track record with their Pershing Square fund of above 20% per year, but still there's no guarantee. And they need to execute this plan of buying companies, because Howard Hughes in itself, the stock, as we will see, has been mostly flat over a very long time. The stock market doesn't really seem to be excited about the master planned community business, even though it can be a nice cash flow generating business. So they need to execute this plan to show appreciation in the Howard Hughes stock price. And so here's the stock itself, Howard Hughes Holding Inc., trading under ticker HHH on the New York Stock Exchange. As you can see, it's been trading sideways for quite some time. It will be a drastic change to the orientation of the company with this new diversified holding company setup. So curious to see where this takes the stock price. It's quite hard to judge what is a good entrance point or how to think about the pricing. One guide here is the 9 million shares that Pershing Square bought from Howard Hughes. They bought it at $100 per share. Today we're trading at about 80, so if we trust their judgment, there is some room there. But otherwise, it all depends on the types of companies they'll buy and the return generated by those companies. So very difficult to judge what would be the right price. So I have a bit of a dollar cost averaging mindset. I just buy every once in a while, maybe when it looks a bit attractive, when it goes down along with the rest of the stock market for some external event that has nothing to do with the company. But overall, that is a bit my strategy. So I hope this deep dive has given you a good idea about the opportunity that Howard Hughes represents. I'm super excited about it. I'll be building my position as we go along, seeing how they progress on their mission, and looking forward to that insurance company announcement in January. Thank you guys so much for watching. Like, subscribe, follow please if you can, and see you in the next one. Keep in mind, guys, this is just my opinion, not investment advice. Do your own research.